Welcome to the Deep Dive. Today we're digging into Aviva's latest numbers, specifically their first quarter 2025 trading update.
Yeah, lots to unpack there.
Absolutely. Think of this as your fast track, getting you straight to what really matters from that earnings call. Our mission, like always, is to cut through the noise, pull up the key insights, and make it all, well, understandable and useful for you.
And Q1 definitely gave us plenty to talk about. The big message from Aviva, a strong start to 2025. They really hammered home the point about profitable growth across the board.
Right. Resilience seemed to be a key word, too.
Exactly. Management called 2025 a transformative year. They sound pretty confident about hitting their targets, and they kept pointing to a strong balance sheet backing it all up.
Okay, so the overall vibe is positive. What about the actual hard numbers? Any standouts?
Oh, yeah. General insurance premiums, they were up 9%.
Pretty solid.
Health insurance sales did even better, up 19%. And the wealth side pulled in $2.3 billion of net flows. That's about 5% of their opening assets under management, so a decent clip.
And within wealth?
The platform business net flows really jumped up 52%.
Okay, that's significant.
And retirement volumes also grew up 4%. So yeah, positive signs across the different businesses.
Okay, those are the headlines. Let's get into the details a bit more. Starting with general insurance, that 9% premium growth sounds good, but what's the story underneath? Any, challenges?
Well, the growth itself, they put that down to sort of disciplined pricing, focusing on getting the rates right and keeping costs in check. That's across the UK, Ireland, and Canada. Yeah. But yeah, there were challenges. Specifically weather. They had some pretty bad weather events in Ireland and Canada.
Oh, okay.
And that really hit the reported numbers. It pushed the group's undiscounted combined ratio, that's, claims and costs versus premiums, up to 96.6%.
96.6%. How does that compare?
That's 8 points higher than the same time last year, so a noticeable jump, mostly because of that weather.
So the weather sort of skewed the main number, the combined ratio. What about the underlying performance if you strip that out?
Exactly. That's the key thing they wanted to emphasize. The underlying performance driven by that pricing discipline and cost focus was actually pretty good.
Okay, let's break that down. UK general insurance first. It's a big part of their business.
Right. So in the UK, growth was strong. Balance between bringing in new business and getting rate increases. Personal lines premiums, think home and motor, up 6%. That's $945 million.
Driven by?
Mostly through their partnerships, the intermediated channels. Retail was apparently steady, but average premiums were a bit lower because the market had softened compared to the really hard market we saw in Q1 2024.
And commercial lines in the UK?
Even stronger growth there, up 17% to $828 million. A big chunk of that increase, $77 million, came from the Probitas acquisition.
Right. Probitas.
Yeah. Growth in their global corporate and specialty area was mainly new business. Rates, they were kind of flat. Overall, some lines up, others like financial lines softening a bit. UK SME commercial grew mostly from rate hikes and indexation.
And the UK's combined ratio specifically, did it also jump up?
Actually, no. Despite the group number being hit by weather elsewhere, the UK GI undiscounted COR improved. It came down 2 points to 95.3%.
Interesting. Why was that?
Mainly because those rate increases they pushed through last year are still earning their way through the books now. They also said their written CORs look good, suggesting they're confident about underlying profitability going forward. And they hit a milestone too, writing over £2 billion in premium across UK and Ireland GI just in the first quarter.
Okay, so UK looks pretty solid. What about Ireland and Canada then, where the weather actually hit?
Ireland GI saw premiums jump 21%, $151 million. Personal lines were strong there too. Underlying COR was okay, consistent. But yeah, the weather losses were significant. Storm Ao, which they said was the biggest windstorm in over 40 years, their losses were in line with their market share, but it was big enough to hit their specific retention level, which is 30 million euros for that kind of event. So Ireland's undiscounted COR ended up at 117.8%.
Ouch. And Canada?
Canada, premiums up 5% in constant currency. That's £94 million. Personal lines grew 10%, mainly from rate increases in auto and property. Commercial lines were actually down 2%.
Way down. Why?
They deliberately trimmed some volume in areas they felt weren't profitable enough. focusing on improving the rates and the overall book quality. But the key point for Canada is the underlying COR improved.
How come?
Rate increases earning through, lower claims frequency, and this is important, big improvements in theft trends compared to last year.
Theft. That was a big issue, wasn't it?
Huge issue, especially H1 last year. So improvement there is good news. But like Ireland, Q1 weather floods in Ontario, snow, ice storms was worse than average. That pushed the undiscounted COR to 96.2%. They did point out the losses were concentrated in Ontario, where Aviva happens to have a bigger slice of the market than average.
Okay, so for GI overall, headline numbers definitely took a hit from weather, especially Ireland and Canada. But underneath, particularly in the UK and with some positive signs like theft trends in Canada, the operational story sounds, well, more positive.
That's a fair summary, yeah.
Yeah.
Driven by things like pricing and cost control, which are more in their hands.
Right. Let's move on then. Insurance, wealth, and retirement. The IWR segment.
Okay.
Starting with protection and health.
Strong sales there, up 19%. Protection volumes got a boost from the AIG deal they did.
Right, the acquisition.
And also apparently more activity through estate agents before a stamp duty increase kicked in. Health just keeps showing really good momentum. In-force premiums up 11%.
Good stuff. Wealth had those decent net flows, $2.3 billion. What was driving that?
$2.3 billion, yeah, 5% of opening AUM. It shows the business is pretty resilient, but the real star was the platform business. Net flows there surged 52% to $1.3 billion.
That's the one that jumped out earlier.
Definitely. Record flows apparently driven by the usual rush before the tax year end, coming through both advisor and direct channels. Workplace net flows were $1.2 billion. Now, that was lower than last year.
Why was that?
They were very clear. It was because they let one single large scheme go last year. They said the pricing got too competitive and they chose not to chase it down. So emphasizing pricing discipline over just volume.
Okay, makes sense.
And importantly, they gave an update for April post-quarter end. Total wealth flows hit £4 billion, which is up 16% year on year. They used that to show the underlying resilience and also mentioned they'd won some new schemes recently. Still confident on hitting their $280 million operating profit target for wealth by 2027.
Okay. Wealth looking strong, especially the platform. What about retirement? Volumes up 4%.
Yeah, $1.8 billion in total. Within that, the value of new business margin, the VMBB, on smaller bulk purchase annuity deals, or BPAs.
Taking on pension schemes.
Exactly. That margin was up 28%. They did 25 BPA deals in the quarter, adding up to $1.3 billion. They mentioned their Aviva Clarity platform, which gives quick quotes, is the competitive edge there.
So are they expecting huge BPA volumes this year?
Not necessarily like 2024, which was massive across the market. They reiterated their guidance of $15-20 billion over 3 years. So the pipeline's okay, but they don't expect a repeat of last year's boom.
Got it. And individual annuities, that was a big jump, 32%.
Yeah, quite striking. They put that down to investing in their operations and systems. Apparently, they were a bit bottlenecked last year and couldn't handle all the volume.
So they've unlocked capacity.
Seems like it. So while 32% is probably not sustainable long-term, they still see 5-10% as the long-term view. This Q1 jump shows they can now actually process the demand effectively.
Okay, so across IWR, platform flows, individual annuity volume capacity seem like the big positives. And maintain discipline on pricing, like in workplace. Let's switch to the foundations of balance sheet and strategy. How's it looking?
Very solid, seems to be the message. Their Solvency II ratio key capital measure is strong at 201%, well above what they need.
What moved it in the quarter?
Main things were 5 points gained from underlying capital generation plus market movements, mostly interest rates working in their favor. Then they used 8 points for the dividend payout. Small positive from some debt actions too.
Anything else on capital?
Yeah, big news was getting shareholder approval, overwhelming support, they said, to cancel their old preference shares. It's sorting out a legacy capital thing, just needs court approval now. And they also successfully issued a new $500 million restricted Tier 1 debt instrument. Got good pricing, heavily oversubscribed, shows market confidence.
We saw some market wobbles after Q1 ended. Did that hurt them?
They tackled that head on, said the turbulence post-quarter end didn't have a major impact on their assets or solvency. Maybe shaved off 1 point by the end of April, which is pretty minimal.
Why so resilient?
They put it down to balance sheet strength and good hedging, plus they don't have huge exposure to equities. Their credit portfolio also held up well. Very few downgrades, none below investment grade. Shows the benefit of holding things through the cycle. Leverage is at 30.1%, factoring in the pre-share cancellation.
And cash. liquidity.
Yeah.
Especially with that big direct line acquisition coming up.
Right. Crucial point. They were very clear on this. Central liquidity at the end of April was 1.8 billion homes.
Okay.
But that's completely separate from another 1.8 billion, which they've already moved over and is sitting in escrow, specifically earmarked for the cash part of the DLG deal.
Ah, so the DLG cash is already set aside.
Exactly. The central 1.8 billion is for everything else. That central pot actually went up a bit in Q1 because of the 500 million RT1 debt they issued, offset by moving the money into the DLG escrow. They expect more cash to come into the group center in Q2 from the businesses, keeping them on track for their big target, generating over 5.8 billion in cash remittances between 2024 and 2026.
So, plenty of cash for normal operations, DLG funds secured, more cash expected. What about the DLG deal itself? Any updates?
Still firmly on track, they said. Got that shareholder vote sorted. Just waiting on regulatory and court approvals now. Expecting it to complete around the middle of the year. They sound well prepared for the integration and keen to get started. And they also just generally reaffirmed confidence in their 2026 group targets.
Right, strategic momentum seems to be there. Okay, let's pivot to the Q&A session from the call. This is often where you get some really good nuggets, stuff investors are focusing on. Tariffs and inflation came up, right? Especially thinking about Canada.
Yeah. They tried to downplay direct tariff impacts, especially for the UK. For Canada, that US tariff on auto parts is postponed for 2 years anyway. But even if it came in, they broke it down. Maybe half the parts element of a claim might be affected, which is only a fraction of the total claim costs.
But they did something about it.
They did make a small precautionary reserve adjustment in Canada, just in case that becomes an inflation driver down the line. So it's factored into that Canadian COR we talked about, like a buffer. UK inflation, generally, they see it running mid-single digits across their lines, expecting it to level off.
UK personal lines pricing, always a hot topic. What was the vibe there? Competitive.
Very dynamic was the word they used. They admitted motor new business rates have softened, roughly tracking the market, maybe 4% down, according to external data. But they said the pace of those reductions was slowing down by April.
And renewals.
Renewal pricing also dipped slightly, about 1% lower in Q1. But, and this is their key point, they stress they built up significant price adequacy through massive hikes in 2023, like that cumulative 47% increase by Q4.
So they feel they have room.
Seems like it for motor.
Yep.
Interestingly, they said they have not lowered home insurance rates, even though the market there is softening too. So sticking to their guns on pricing discipline for home, it's a balancing act.
Okay. We talk about liquidity, but just to be crystal clear on that central cash versus the DLG cash.
Yes, they really spelled it out in the Q&A. The 1.8 billion central liquidity is definitely separate from the 1.8 billion DLG escrow funds. They explain the flow. RT1 issuance boosted central cash, moving funds to escrow reduced it. Upcoming drains on that central cash are the preference share cancellation, about $665 million total, and the final dividend payment. But again, big cash inflows expected from the businesses in Q2 and beyond, keeping them on track for that 5.8 billion plus target over 3 years. Message: we have enough cash for core stuff. DLG is funded separately.
Annuities, margins, and outlook, that came up too, right?
Yeah. Q1 margins on BPAs were high. They explained it was mainly down to the mix doing lots of smaller deals, 25 of them. Smaller deals often carry better margins than the big, super competitive ones.
Let's expect that to come down.
Yes. They expect margins to normalize as the year goes on, and the mix potentially includes larger deals, guiding back to overall retirement margins similar to last year. And they stuck to the 15-20 billion BPA target over 3 years, acknowledging its lumpy market, but they won't chase deals below their required returns.
And the 32% individual annuity growth.
Yeah, they confirmed that was high, partly because their improved systems could finally handle the volume they couldn't last year. So expect that rate to normalize, but still grow strongly compared to the 5-10% long-term view, just because they can now service the demand.
Any final interesting bits from the Q&A on, say, UK claims trends or commercial pricing?
UK GI claims, inflation still mid-single digits, expected to plateau. Frequency, especially motor, kept improving, fewer accidents. They mentioned things like mild winter weather later in the quarter, operational improvements, maybe even 20-month zones helping slightly. January weather did cause a small blip upwards, though.
Commercial pricing.
UK commercial rate momentum is slowing, so they need to be selective, but they're keeping clients 90% retention. GCS seeing rises in motor, specialty, liability, property investors, but financial lines softening. Mid-markets still getting decent price hikes. Canada inflation is running 5-6%, but their rate hikes, like 11% on auto property, are covering that. Commercial renewal rates there were a bit below inflation, but off a strong base. Retention dipped to 86%, partly because they exited an unprofitable scheme.
Wow, they really covered a lot of ground in that call.
They did, yeah. A lot of detail trying to explain the moving parts behind the results and where they're heading.
Okay, fascinating stuff. Now it's time for our favorite segment.
Right, and remember, this is not financial advice. This is purely for entertainment purposes. Please do not act on this.
Absolutely crystal clear on that, but let's use the specifics from the call, especially about Canada, and brainstorm a wild but maybe just plausible trade idea. Imagine we're pitching this to a skeptical investment committee.
Okay, committee, listen up. We heard Aviva Canada's Q1 results were hit hard by weather, right? But crucially, that weather was concentrated in Ontario, where Aviva just happens to have a bigger market share than average.
Okay, geographic concentration.
And at the same time, we heard very clearly that theft trends there have improved significantly compared to early 2024. Plus, they're applying disciplined pricing actions region by region.
So the market might just see the bad headline, COR for Canada.
Exactly. The market might be looking at that high Q1 number, comparing it broadly to peers, and maybe not fully pricing in the positive impact of those specific Aviva actions, the theft improvement, the targeted pricing, or the fact that the bad weather was geographically specific to them more than others.
So the underlying reality could be improving faster than the headline suggests.
That's the thesis. The outrageous part is betting on specific regional weather patterns going back to normal after Q1. Combined with these micro-level operational wins theft reduction, pricing leading to Aviva Canada's underlying profit improving faster than people expect, especially faster than peers who maybe didn't have the same theft problem to recover from or aren't as exposed to Ontario where Aviva is pushing price.
Okay, lay out the trade.
It's a pair trade. Theoretically, you could try and short a basket of Canadian insurers you identify as having high Ontario exposure, or maybe those who haven't talked about similar theft recoveries. At the same time, you go long Aviva.
Betting on divergence.
Precisely. The bet is that Aviva Canada's underlying performance, currently masked by Q1's weather noise, starts showing through with better than expected COR improvements relative to those specific peers over the coming quarters. This could lead to Aviva's stock outperforming them. It's a gamble on operational detail and regional specifics beating the broad narrative.
That is definitely granular, very specific. And yeah, definitely requires homework on competitors. A truly wild but plausible idea for our listeners' entertainment only.
Strictly entertainment. Don't try this at home.
Okay, let's wrap up this deep dive on Aviva's Q1. Key takeaways. A strong start overall, profitable growth across the different parts of the business, GI, wealth, retirement.
Resilience, despite those weather hits, showing the underlying business is performing.
And a solid balance sheet, good solvency, managing liquidity well, especially separating out those DLG funds and taking actions to tidy up capital.
Plus that strategic momentum Probitas integrating, DLG acquisition moving ahead, confidence in hitting future targets.
Right. Understanding these details, the difference between a headline and underlying how they handle risks, the strategy, it helps you gauge how well they're executing in, let's face it, a pretty volatile market.
Absolutely. Context is key.
And just one last time, this was our analysis of the call, definitely not investment advice. But here's a final thought for you to chew on. Aviva calls this a transformative year, largely because of the DLG deal. As that integration happens, how do you think successfully merging with a major competitor like Direct Line will reshape not just Aviva's own numbers, but the whole competitive playing field for insurance here in the UK and maybe even beyond?
That's the big question looking forward. Something to watch. Thanks for tuning into this deep dive. We hope you found it useful.
Yeah, thanks for joining us.